Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little bit of money here. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Let me start out tonight by saying I am not a tech apostate. Far from it. I've loved tech ever since 1982 when Texas Instruments was cutting edge and National Semiconductor revolutionized those little silicon devils. But days like today, where the Dow dipped 32 points, S&P advanced 0.11%, and Nasdaq edged up 0.22%, these days challenge my assumptions on tech, even the ones I push in how to make money in any market, like the idea that these are still the best tech stocks to own long term. I still believe that. But you know what? You got to be thinking long term, because right now, putting new money to work in this scrum of a sector feels a little early buy, especially when the best acting tech stocks right now have the worst balance sheets and income statements, and the real good ones, crossfire. Again, I'm not turning against tech. I'm simply saying that when I pick stocks, I like easy money, and I like to avoid the battlegrounds. Lately, I've been trying to direct your attention to the easy money groups like the banks, wow, the transports, woo, and even the healthcare companies, which have been tremendous. With the Fed in rate-cutting mode, you want to own stocks that will benefit from easy money, like a railroad that has no competition, or a credit card company, or something related to travel and leisure, or fast-growing retail, like Dollar Store, for instance. The dollar stores are on fire. Not a lot of battlegrounds there. There's only a couple of them, but tech. Let's just say I know the first day of the psalm when I see it, and I don't want to go over the top into this current madness. Make no mistake. This is brutal trench warfare we're experiencing. I want to walk you through some of the battlegrounds. Let's start with Amazon Web Services, which is having an incredible conference, reInvent, it's called, reInvent 2025. It's in Las Vegas. It's ongoing right now. Now, I know what happens in Vegas stays in Vegas, but this was ridiculous. The reaction to this conference didn't even leave the building, let alone go to Vegas. Nothing. In fact, the stocks reacted terribly to the conference. Now, this was Matt Garman's show, who took over AWS job from Cramer Faith Adam-Slipsky last year. I'm a generalist, not a technologist, like the tech bro from the Technology Business Programming Network, or TBPN, who were kind enough to interview me today and were really terrific. Speaking as a generalist, though, I thought that Matt did a great job on the show, showing off all these new gizmos and software and on-ramps that Amazon Web Services now offers. I thought it was fantastic, frankly. But I think from the stock, it looks like I'm the only one who thought that. Second, there's Salesforce. Now, we have CEO Mark Benioff on tonight, and boy, I love this quarter. When his company reported last night, it was lights out, people, lights out. He laid out a multi-year program for Agentforce that suggested Salesforce might have the agentic AI space to itself. This could be one of the largest markets in history. This is the holy grail, people, for customer service. An informed salesperson at the point of contact who knows everything about you and is ready to help you instantly, can't make mistakes, many languages, even as it's not a salesperson at all. It's not a person. Salesforce now has the holy grail. An Agentforce bot answers your phone call, knows all about you from the get-go, and can service you better than any human, mistake-free, all for a fraction of the cost. And by the way, can I just tell you, no health care, no days off. It's amazing, which is exactly why Costco, the world's best retailer, and CVS, the biggest drugstore, both chose this technology, and I'm told that they love it. This is a new business line for Salesforce, just unveiled last year on our show, by the way, and it's already hit a $500 million run rate. I think Agentforce can redefine this company within the next 12 to 18 months. I think they should rename it Agentforce. If I were kidding, I wouldn't have said it. The reaction, well, the stock immediately jumped more than 20 points last night. That's right? But then it gave it all up. I mean, every penny of it. And then, of course, it did rebound in the afternoon and it closed higher. But, I mean, this thing was down at one point. This was crazy. While investors came to their senses later on, the fact that Salesforce was down even briefly today just shows me, wow, this is one nasty tech market. Third example. There used to be some honor among thieves in Silicon Valley, a sort of no-poach rule that led to a lot of rich executives filled with stock-based compensation. Then along comes Mark Zuckerberg from Meta, and he's poaching like mad, building the best roster in the industry. He's going after some very talented execs from Apple, including one we just learned who ran Apple's liquid glass portfolio, which I'm very interested in. What the heck? I know this is how it's supposed to be in a free market economy, but in practice, the big boys never really tried to compete on salary. Now they have free agency without a salary cap. Nightmare. Meanwhile, Zuckerberg's cutting his metaverse spend. A black hole that I thought might stay a black hole, because when you're making as much money as Meta is, does anyone really need to be laid off? Apparently, yes. You know what I've been thinking? Zuckerberg makes Elon Musk look like a real softy. All right, let's get to the biggest publicly traded battle, the one that feels like a combination of Verdun and Gallipoli. I'm referring to the travails of Jensen Huang and NVIDIA. First, let me say there must be 3 or 4 Jensen Huangs running around. Remember little Jensen? Because he's everywhere. Congress, the White House, Joe Rogan. Joe Rogan. He's on the firing line every minute, this guy. A firing line that feels more like the firing squad at the end of Paths of Glory, an unjust execution that Jensen's going into with his eyes wide open. I feel that Jensen's fate, I feel it's his fate every day. I don't know how he stays sane, honestly, and he stays funny, too. Noting that he's the only person who isn't allowed to do business in China, banned by both sides. If you believe the critics, somehow his chips are both inferior to the homegrown competition from Google, yet so incredibly advanced that we can't let the People's Liberation Army get its hands on them. It's all a canard, people. NVIDIA semis are superior. Companies are making billions of dollars when they buy them. It's not a dead weight loss CapEx bunch. If he charges too much, then why is the huge buyer, which Alphabet, they make their own, but they're a huge buyer of NVIDIA, why have they seen their market capitalization at hundreds of billions of dollars in value, buying a fraction of that from him? I don't get it. I mean, why isn't that ever talked about? You want to own this stock, not trade it. And the stock was up almost $4 today. But NVIDIA's become torturous, and there's friendly fire going off everywhere as Jensen toggles between the globalists and the jingoists. Instead of just walking the grass-lined walls of his home turf, taking selfies and chatting with his teammates. Finally, I want to end with the ultimate battleground of all time, OpenAI. Here's a company that made $1.4 trillion in spending commitments based on what now seems like a tenuous lead in the chatbot space with ChatGPT. They had to field themselves for 3 years. People were throwing money at it, but all of a sudden, Google merged with Gemini 3, and there's a general acceptance that OpenAI has relinquished the crown. Of course, it could come out next week with a new version, and it could leapfrog over Gemini 3, but it'll cost a fortune to stay in this game, and we don't know if that company can raise that fortune. Could CEO Sam Altman be King Midas in reverse? Or will he settle for being the biblical Samson post-haircut? Either way, not a good ending. The fact is, these aren't banks, so there's no real too big to fail metaphor going on here. But there's just something existential with this cohort, as if the whole group is winner take none. You think Union Pacific is winner take none? How about Goldman Sachs? JP Morgan? Johnson & Johnson? Even Bristol Myers can go higher in this market. Here's the bottom line. I'm not advocating the wholesale abandonment of the pest sector in history, not at all. I am saying, however, that there is a fierce competition with enfilading fire and exploding claymores everywhere, and it's showing no signs of abating. But boy, oh boy, is it entertaining. Unfortunately, we don't value stocks in entertainment per share, which is why you should focus on boring stocks of companies that tend to win big when interest rates come down, aside from just owning a lot of tech. Let's go to James in my home state of New Jersey. James.
Boo, 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 booyah from Belmont, Jim.
Oh, man, Belmont. Right. Oh, man, Dolce Vita. I wish I had that spaghetti clam sauce right now. Always wear a bib. Always wear a bib. Don't let it ruin your shirt. I had 2 shirts ruined there. Nick does the greatest job. How can I help?
But while cooking my booyah bolognese sauce, I heard you say one day, Robinhood, I can't believe the stock is so
Robinhood
cheap.
goes higher. It goes higher because it's a proxy for all the young investors. See, young investors, they're on Robinhood, the app, so they buy Robinhood the stock. And you know what? They've been winning 267%. That makes other people want to be in. Winners win. Stupid metaphor does work. EPS doesn't mean entertainment per share, people. It's okay to stick to boring stocks. They'll make you money. Augment your tech portfolio with some boredom. Oh, man, I'm going to tell you, Salesforce delivered a big beat in the quarterly report, as I said just earlier, didn't send its stock higher. I'm getting all the latest in agentic AI with the company CEO. Then, what's behind this new upward trajectory in drug maker Merck? I'm digging the company's pipeline and what's making it stand out from the pack. And prediction markets have become some of the biggest places to make trades on everyday events. I'm learning more about Kalshi and how it's been transforming the space with the company's CEO and a new relationship it has with CNBC. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Past year, most of the cloud software stocks have been punching bags as Wall Street figured out they'd been eaten alive by competition from AI. But last night, Salesforce reported a great quarter, okay? And today, the bulls were in control. While the quarter wasn't all perfect, the slightly weaker than expected revenue, the company delivered a terrific earnings beat. Management raised their full-year forecast for the 2026 fiscal year. At the same time, Salesforce had some incredibly encouraging updates on Agentforce, their suite of tools that can build AI agents, automate all sorts of white-collar work with annual recurring revenue already of the product reaching $540 million this year. That could be a record. So could this be a start of a comeback for the stock, which is down 27% for the year? Let's check in with Mark Benioff. He's the co-founder, chairman, and CEO of Salesforce to find out. Mr. Benioff, welcome back to Mad Money.
Jim, it's always so great to see you. Thank you for having me on your show once again.
All right. Well, Mark, I'm going to start with something very simple. I'm not going to mince words. This was a great Agentforce quarter. And I want to tell you, I want you to seriously consider what I say. When I look at your deck and you have one page, on page 15, you say Agentforce sales, Agentforce service, Agentforce 360. But Mark, this business is going to be bigger than your other businesses. And I think you should get ahead of it and call your company Agentforce. I think you should rename it.
Jim, you were at Dreamforce, weren't you? In San Francisco. We were all there together having a great time. And we were there with 55,000 customers in person, 10 million online. You've seen even the Dreamforce keynote has 11 million views on YouTube. It is unprecedented. And I'll tell you, Jim, why everyone is so excited about Agentforce is because this is what AI was meant to be. It brings together humans and data and AI and apps and delivers an incredible experience for companies. And you can see it in these results that there are now thousands of Agentforce deployments, thousands of customers who have found the promise in AI that we've been talking about now for over a year on your show. And it is the fastest growing product I have ever seen in the history of Salesforce. But I don't have to tell you, you saw it, you were there.
Well, I saw it and I kept thinking, just like when Jensen first showed me what he was doing with ChatGPT, I said, why aren't all the great retailers? I said to you, CVS has to do this. And you said, well, I didn't have CVS. They haven't called. Well, I spoke to David Joyner. CVS is in love with this product. And the reason it is because it speaks many different languages. It makes no mistakes. It doesn't put you on hold. And it gives CVS such a leg up over everybody else that I now think this CVS is a great stock because of Agentforce.
Well, Jim, you are right that CVS is an incredible customer of Salesforce deploying Agentforce, and even throughout Aetna as well, we see incredible action in the healthcare industry. But I also want to pivot quickly back to Dreamforce because you spoke to Michael Dell, who has deployed 20,000 of his most important suppliers using Agentforce supply chain. Incredible, bringing another level of compliance and governance and intelligence to the most important supply chain in the world with Dell. I mean, the results have been just incredible. And while we're in healthcare, let's talk about an unbelievable win that just happened today with AstraZeneca. We're seeing pharmaceutical company after pharmaceutical company, including, Albert. You talked to Albert.
Sure,
Pfizer, who went with our
tremendous anti-cancer
franchise. Cloud.
Well, how about the greatest retailer in the world is no slouch to what happened at Walmart and how good Doug did, but Costco is the #1 retailer in the world. And when I saw that they decided to use you, what that meant was they have a zero tolerance of going down for every aspect of this. They never go down. Your reliability must be equal to their zero tolerance.
We love working with Costco, and of course, we love all of our retailers equally. They're like our children. But I'll tell you what, Jim, Costco's amazing. Their CIO is an incredible person who we worked with also at Procter & Gamble, at Coca-Cola, even at Mondelez. And now they've got him there automating Costco for the very first time. It's a very exciting story for Costco based in Seattle, Washington. But I'll tell you something, not only do we have that, but it's that life sciences business that we were just talking about. It's really on my mind. You see, not only do we have AstraZeneca, not only do we have Takeda, not only do we have Novartis, not only do we have Pfizer, we're just knocking them all down. And I'm thrilled they're all moving from Viva to Salesforce and Agentforce Life Sciences. It is really exciting to see this competitive motion where these agent-based systems can replace the old client-server software of the past.
It is amazing. Now, Mark, I do worry. You the other day had a change of heart. You said Gemini 3, you had a holy yes moment. Is there something that could come out that would make it so all of these people and companies we just mentioned would say, I don't need Agentforce, this one's much better? Or do you have something like their data, for instance, that would make it so it would be foolish for them to move?
Jim, what makes AI powerful for the enterprise? It's a combination of a few things. It is, of course, a killer app like Slack or a sales product or service product. You've got to have the killer app. Then you have to have the data, the relevant customer data. I showed that to you because I showed you how Agentforce prepared me for this call. Amazing.
No,
and then, of course, it has to generate the context. And then you use the large language model, which is the AI, to bring it all together, Jim. But that large language model is just a commodity feature. We can buy it from, yes, right, OpenAI, you mentioned them, or Google, or Anthropic, or we can get on an open source. They're all the same, Jim. All these large language models are the same. We just want the lowest cost one. Right. Then we plug it in. We've got all the customers' data. We have our killer apps. Those are not commodities. Slack is not a commodity. Right. Sales Cloud is not a commodity. Service is not a commodity. And then Tableau is not a commodity. That then gives you this incredible new product. And that is what has happened. And it is just awesome.
Now, this AI eating software, canard, I think, when it comes to this new business you're in, is it worrisome? You know, your guys are willing to say, look, it's 12 to 18 months. There is a transition you have to undergo. There can be some, but your numbers already contain any attrition that you think could happen from your older businesses.
Jim, this has really been one of the saddest things that have happened in the whole year is that investors have moved away and missed out on a day like today for Salesforce because they somehow think software companies are under duress from AI when the opposite is true. Jim, software companies are being bolstered by AI, powered by it. You saw it yourself at Dreamforce. You were a witness.
No, I wasn't
seeing how excited
just
customers are.
Same way I was when I was
you saw it, Jim, yourself.
Well, because nobody else has the product. I have very rarely seen a monopoly on customer service in this world, and you have it. No one else even believed in it. You have the best ads. I mean, I'm not kidding. Look, believe me, you know we had a tussle on some of this stuff. Not anymore because you won. You won, and I'm sure that you could have put Ford in because I know Farley loves your product.
Listen, of course, Salesforce is the largest enterprise software company in the world. We're doing more than $41 billion in revenue this year. We have more than 80,000 employees. We're number one in every critical country, from the United States to Japan to the United Kingdom and France. Salesforce is the number one enterprise software company in the world. But Jim, here is the stat I've never given you before, the most important stat. And this will not be the last time I give it to you. This is the first time. 3.2 trillion tokens that we've delivered so far with Agentforce. 3.2 trillion
people
tokens.
At home
now, you know,
listen, they're thinking it's subway tokens. You got to help the people at home.
They think it's JRR token and Bilbo Baggins is coming on the show next.
You used that in the call. I thought it was very funny. It was like, then you said, okay, I won't do any more jokes. I guess no one laughed. I thought it was funny.
Nobody laughed. This is tech humor. Tokens, 3.2 trillion tokens. That is the evidence that Agentforce is delivering value to these customers. And Jim, how many enterprise software company executives or any executive, any tech company so far has delivered to you and said, I delivered this many trillion tokens so far? And I might be the first, but I will not be the last.
Well, look,
and here's why, Jim. It's because you saw at the OpenAI Dev Conference, they said, oh, here's the trillion token club, and we were one of the top 5.
Right.
Well, all of those vendors have their top 5, and we're all in their top 5. The Google or the Anthropic or the OpenAI, AI or the open source vendors. When we add it all up, so far we've done 3.2 trillion tokens. What we're going to see is that we're going to deliver a level of value to these customers. We're going to make things so easy to use, so low cost, so reliable,
in an era
so
where
available.
we do not have
we're
enough
delivering
people,
AI.
enough good people to do who you're replacing. It's not like you're replacing people. We don't have them. It is the only force multiplier. It takes customer service from being a minus to plus. And that was always the dream. And you figured it out. And I want to congratulate you. You figured it out, Mark.
Thank you. Well, Jim, Agent Force accounts in production are up 70% quarter over quarter. But it was only a year ago that we used the word Agent Force for the first time on the show.
I came up with it. Did I?
People are always overestimating what you can do in the first year, Jim.
All right,
but
well, look,
underestimate what you can do in the first decade.
Let's put it this way. It's a different company as of that release. And I want to congratulate you because there's no more controversy, Mark. That's over. Thank you.
Jim, you were there. You were at Dreamforce. You saw it all happen.
Thank you very much, Mark. Mark Benioff's the CEO, co-founder, and chair of Salesforce, CRM.
Great to see you, Jim. Come back to San Francisco and see you. We love you so much, Jim. You're the best. You're number one.
Thank you. Mad Money's back after the break.
Coming up, can drug maker Merck keep its recent momentum, or does the stock need a new prescription? Cramer's diving in and giving you his take next.
After spending most of the year in the doghouse, big pharma's come roaring back over the past 5 odd weeks. Have you noticed that? Ever since most tech stocks peaked near the end of October. Since October 29th, Eli Lilly, which we own for the Travel Trust, is up a whopping 25%, briefly joining the Trillionaires Club about 2 weeks ago. Meanwhile, Amgen, Regeneron, and even Bristol Myers are all up double digits. But there's one drug company that I got to tell you I'm particularly impressed by right here, and that is Merck. Up almost 17% since the tenor of the market changed on October 29th, and much more than that if you go back a few months. I've long been a fan of this one. The investment that changed my entire life was a big bet on Merck options back in the 80s. But the stock ran into some turbulence after it peaked at just under $135 in June of last year. From there, it's experienced this incredibly sickening decline. I mean, this thing is for Liz. I mean, this thing fell all the way down to 733 and change in May. With the stock above 101 now, Merck's made a comeback, but it looks like it took some time. I mean, the stock was still in the high 70s in late September. And that's when it became a juggernaut and started charging back to the triple digits. Now, some of that's because Wall Street had no interest in big pharma for most of 2025. We had so many red-hot AI data center plays and turbocharged speculative stocks. Nobody cared about dowdy old Merck or its compadres. Didn't help that the White House kept saber-rattling on the need for lower drug prices. Now, though, the year of magical investing is winding up. Okay, we had a rebound today. I get that. Rebounds can happen. But as I told you yesterday, you have to use these rebounds to ring the register on the way up as these company stocks go higher. And you got to scale out to get into the best companies we have. You got to scale out into companies like Merck, which have good dividends and good growth. That's made big pharma traditionally a defensive sector a lot more attractive. At the same time, Washington hasn't done anything really to truly hurt the industry's profitability, has it? Now, Merck was held back by some company-specific issues. For some reason, we still don't really understand. The Chinese pretty much stopped buying the company's popular HPV vaccine, Gardasil, which is maybe the most effective way to prevent cervical cancer. For whatever reason, China stopped buying it, and eventually Merck just gave up. I mean, shipments are paused at least until the end of the year. If you can understand that, tell me. I do not understand why a country's government would stop giving people a drug that saves lives. That's China. More importantly, Wall Street's been bracing itself for Merck to lose patent protection on Keytruda, its blockbuster cancer treatment that's been the best-selling drug in the world for the past 2 years. Although it's about to be surpassed by Lilly's miracle GLP-1 weight loss drug, people are really underestimating what it'll mean when that thing goes on Medicare. Still, Keytruda accounts for nearly half of Merck's sales, and its patents expire in 2028, and that's caused the price-earnings multiple to shrink here. So what's gotten better recently that's allowed the stock to rally? All right, well, let's start with the China issue, which really hasn't improved all that much. The one change is that this Gardasil issue started in the summer of 2024. So they've now lapped it year over year, which means they're up against much easier comparisons. When Merck reported at the end of October, Gardasil sales were still down 24% year over year. Not great, but much better than the 55% decline we've seen in the previous quarter. Plus, Merck's overall growth rate turned positive again, up 4%. This was the best quarter we've gotten from Merck in quite a while, with a healthy revenue beat Keytruda sales up 10%, and their animal health division up 9%. The company's also seeing great numbers from Winrevair, their new pulmonary arterial hypertension drug, which put up $360 million in sales for the quarter. It's already a blockbuster that was introduced on the show. I don't know if you remember. This is something Merck picked up from the $11.5 billion acquisition of Acceleron Pharma back in 2021, which brings me back to my next point. The people who run this company are not idiots. Right? They've long known that Keytruda would lose patent protection, so for years they've been making acquisitions to build up their pipeline. In early July, Merck announced the acquisition of a British company called Verona Pharma for roughly $10 billion. Verona is focused on respiratory diseases, and they already have one drug on the market, the first new maintenance treatment for chronic obstructive pulmonary disease in more than 20 years. It will be another blockbuster, I predict. Then in mid-November, Merck did another deal. They're buying Cidara Therapeutics for another $9.2 billion. Cidara specialized in something called drug FC conjugate therapeutics, which in plain English is a delivery mechanism that helps target specific viruses, infections, even tumors. Their lead drug candidate is an antiviral agent that can prevent influenza in people who have high risk of flu complications. Technically, it's not a flu vaccine, but functionally it does the same thing and seems to work for every strain of the virus. So Merck's been making ample preparation for a world without Keytruda exclusivity, and the analysts are starting to notice. Last Monday, Wells Fargo upgraded the stock a note entitled, "We can see a future beyond Keytruda." Given the strength of this pipeline, this analyst sees Merck, quote, entering a catalyst-rich period in the next 12 to 18 months with readouts across its pipeline, end quote. In fact, they said that Merck may have added or de-risked over $20 billion of unadjusted peak sales just in the last 3 to 6 months. It sounds good to me. They're no longer predicting a huge drop-off in sales in 2029 through 2031. The first full years where Keytruda will be off patent, and they see Merck returning to growth after 2031. Look, I think it could actually happen sooner than that, which is why I like the stock so much. According to Wells Fargo math, the stock currently sells for less than 9 times next year's earnings, although when you use the consensus estimate, it's more like 11.4 times earnings. Either way, that's darn cheap. It's why I've been saying it's time to get out of the fly-by-nights and get into the reals. So let's put this together. In general, the big pharma stocks have been doing much better since the end of October, as Wall Street's gotten a lot more antsy about tech, and RFK Jr. hasn't really cracked down on the industry and health and human services. Meanwhile, the previously downtrodden Merck has become a standout performer. The bottom line, as a long-term admirer of Merck, and I'm talking about decade after decade, I do love to see this new trajectory. Of course, I wouldn't be surprised if there are setbacks along the way. That's the nature of the drug business. But for now, Merck's a very cheap stock that still doesn't even get nearly enough love for its terrific pipeline, or for that matter, its solid 3.4% dividend yield. Believe me, you could do a lot worse. Let's take some calls. Let's go to Steve in New Jersey. Steve.
Hi, Jim. How you doing today?
I'm doing well, Steve. How are you doing today?
Doing okay. My question today is about Eli Lilly. With the stock dropping daily since its 1,100 high a few weeks ago, in your opinion, where would be a good entry point to start a position?
I think that people now are getting antsy and thinking that it's really breaking down. That's probably when I want to start buying. I think that we're very close to the Medicare payment, and it also has new indication after new indication, new readout. Buy some here and then do what's known as a scale. Let's say you buy 5 here, you buy 10 at 900, and maybe you buy 20 at 950, and then you'll have a really nice pyramid going. That's what I like. All right. Anyway. I love to see this new trajectory in Merck. It's a cheap drug stock with a terrific pipeline. It could do a lot worse. Much more Mad Money ahead. As prediction markets take the world by storm, I've got an exclusive with the CEO of Kalshi to find out more about what's happening and what's next. Then there's always an opportunity to be had in a turnaround, as long as you can spot one. I'm digging deeper on one retail name in particular that's been acing its comeback. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with me. Over the past few years, and especially the last 12 months, we've witnessed the rise of the prediction markets, where users can put their cash to work betting on just about anything. The leader in the space, at least in the United States, is a privately held company called Kalshi, which has opened up a nice lead for itself by working cooperatively with the regulators. They even got skewered a South Park episode earlier this year, which shows you that's when you know somebody's made it. This week, Kalshi raised $1 billion in a Series E funding round that valued the company at $11 billion. Then today, our network, CNBC, announced a multi-year agreement with Kalshi, which includes the use of Kalshi data for editorial purposes as well as commercial components. You know what? I think it's long past time for us to really take a closer look at this story. So let's dig deeper with Tarek Mansour. He's the co-founder and CEO of Kalshi to learn more. Mr. Mansour, congrats on the fundraising, congrats on the new partnership, and welcome to Mad Money.
Thank you for having me, Jim. I'm very excited to be here.
Okay, so I think even though the younger people, as I mentioned, the people who watch South Park know you, I do have to ask you to do like a Kalshi 101 for people who don't know exactly what you do, if you don't mind.
Totally. So we started Kalshi with a simple premise. What we're building is a financial market, like the stock market, but for everyone. So you can trade, buy and sell yes or no shares on whether Brexit is going to happen, Trump is going to win an election, whether it's going to rain tomorrow, whether COVID is going to come back, or whether Taylor Swift is going to release an album this year. These markets work so well because, like the stock market, they price the future. They are predictive. And so Kalshi has become the leading and most trusted brand for forecasting anything about the future, whether it's an election. You saw Mamdani using the odds over his most recent election. Yesterday, the Secretary Besson was talking about who's going to be the odds of the next Fed chair and so on. And this is why we're so excited about the partnership, bringing these forecasts to CNBC.
Well, that's true. I mean, for instance, I'm incredibly concerned about the tariff decision in front of the Supreme Court. It seems like a perfect thing to be able to, for some people, to wager on. But for me, what I have to do is try to figure out whether I can incorporate that, because there are a lot of knowledgeable people who'll be betting, and some of them may not be knowledgeable. But the wisdom of the crowd, it does matter, I think, to figuring things out.
So the thing here is, and the reason why the markets work so well, is one, they aggregate the crowd wisdom. But number two, which is critical, it's people that have skin in the game. People don't lie when they have money on the line.
Right.
They're not pundits. They're not subjective. They're thinking about what they're predicting because they're putting money on it. They're putting money where their mouth is. And that's a very critical piece here.
No, you're right. I mean, look, we're resident in Pennsylvania, and they called us like 10 times a day during the primary, right? And during in the presidential election, and you felt like just telling them the wrong thing. I mean, how many times? Okay, now that I'm for Mickey Mouse at this point. So you're right. I mean, people don't have when the pollsters call. It shouldn't matter. Now, how about this work that you did with the CFTC? I think this is really important for people who think, wait a second, is this cowboy? This is not a cowboy situation.
Yeah, totally. Look, we spent 4 years working with the federal government, with the CFTC, to regulate this model as a legitimate financial asset class before we launch a single product. And the reason was always, the vision is to make this a real legitimate financial market and to expand the universe of what is a financial market. Traditionally, a financial market is a stock or a commodity. Now a financial market is this idea of an event contracts where people can put money behind their opinions and predict the future. But the regulatory piece has been a very core principle in the company.
Okay. Now, I also want to know about your competition. I mean, I think we're kind of aware it's Polymarket. I saw them because they have a deal with ICE, who is our landlord here. What's the difference between you and Polymarket when it comes to a user experience?
So look, I mean, I think the success we've had this year has opened a bit of a goldmine. It was a bit like a ChatGPT moment. And what happened in AI when ChatGPT happened, everyone and their mothers went after that market. And, we're seeing competition from offshore competitors, from incumbents, from legacy players like the CME. And we're really excited about that competition because it's a testament to how big the market opportunity ahead of us is.
Okay.
And Kalshi is the market leader. What we're going to do is keep building a great product and keep going.
Well, is it like Robinhood, where they basically won because they had the best app? Will that matter?
I think for us, it's largest diversity of markets.
Okay.
We have 3,600 markets on Kalshi today across economy, weather, politics, culture, and so on. Liquidity, like with any financial market, and it's hard to build liquidity, and technology, the product. When you use the product, it is the best product on the street today. Okay,
now how do we address the notion that if you're from states where there's no legalized gambling, you can gamble through your company? Is that a conflict? Are you concerned that people might say, wait a second, you're getting around the regulators?
Look, I mean, it is not a secret that financial markets pretty consistently throughout history, and you might know this, Jim, there's always this tension. People call it gambling, or people are speculating what's going on here. But there's a few things that are important here. So we're regulated by the federal government because we're a neutral, transparent financial market. We're like the New York Stock Exchange right here. People are trading against each other. So it's Jim against your friend or your friend against Jim. There is no house.
Right.
And that's very critical. In traditional gambling model, there's a house. And the house always wins. On Kalshi, there's no house. Anybody can win.
Okay, now, it seems like this progression from June to October to now in terms of the valuation of a company, it's pretty rapid. I mean, what was it, $2 billion, then $5 billion, and now this level? Does it give you, I mean, because you're probably a student of history, you're a younger person, but you're obviously a student of history because of what you do for a living. That's a very, very rapid rise. Does it? Do you say, wow, I don't know, a lot of companies could be attracted to that. Maybe there's going to be 100 guys who come in here. Yeah,
well, I think competition is a good thing.
But at a certain point, if you're ChatGPT, it looked like a good thing, and then it turned out to be not so good.
I mean, look, I think inevitably, there's like two types of markets. A market that, are small and a market that are massive. In a massive market, we live in a free market. There's going to be competition, inevitably. And so I think there is only one way to proceed and go forward is to build a great product. And, competition is going to push us to keep building a great product.
Wait, let's just deal existentially. We have young people. I'm trying to get them to invest in companies because I think it's the power of compounding, the greatness of American business. And against me might be people who just want to gamble, whether it be gamble on a parlay, 4 tight ends this weekend, or on, what's the next state that Russia's going to go after.
Yeah.
What do we tell people about trying to get them to invest when we're also trying to promote what some people just say is out and out gambling?
Look, I think the way that we think about what we're doing is we're sort of opening up, growing the sort of universe of what people consider a traditional financial market.
Right.
To bring in people that, historically don't really understand traditional financial market. They don't feel like they work for them. They feel like the game is rigged. The new generation feels like the game is rigged against them because the large institutions have kind of have asymmetric information, they have access that they don't have, and so on. But the beauty of what we're building in Kalshi is everyone is an expert on something.
Right.
Whether it's culture, what Taylor Swift is going to do,
That's
sports,
a really good point.
And economics, and Kalshi is an outlet for you to basically make money off of that passion or expertise.
Instead of just putting it on X or having some posting that shows you have expertise, just go, why not make a little money on your expertise? Yeah. I like that. That makes me feel very good.
Instead of debating people on X, you can basically make money.
I really like that. I want to thank Tarek Mansour. He's the co-founder and CEO of Kalshi, and I want to, again, it's important that we have a partnership we just announced with them. I don't want anyone to think, why didn't he say that? Because I know that you trust me, and I know that I want you to know that I understand our relationship with Kalshi. Mad Money's back in.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time for the lightning round. Christmas Robert Close. We're saying this talking to about my buy, sells, just giving another cards. I had to tell my staff for graphics, but you play the sound. And then the lightning round is over. Are you ready, Ski? Let's start with Ron in California. Ron.
Jim, is that you?
You bet it's Jim. How about you? Is this Ron?
Jim, my heart's beating a mile a minute. I'm shaking right now. You're the best thing since sliced bread. Your caller told me to do this short and sweet. I'm going to do it all in 30 seconds. Are you ready?
I am ready, Ski Daddy. What do you got for me?
A year and a half ago, I bought this particular stock. Every time the earnings come out, I get more and more upset. The stock keeps dropping. I think they're going to turn around, and here's why I think they're going to turn around. $30 million in October from Roche Genentech. $785 million in cash. They're going to have a major announcement on one of their drug trials on December 8th. I think it's going to be favorable, but here's the big thing. Najat Khan, who is a genius, takes over for Recursion Pharmaceuticals on January 1st with her experience and expertise. I think 2026 will be a banner year for Recursion. Take it from there, Jim.
Well, Ron, I'll tell you, I am myself confounded by it. The stock has been horrendous. We got to put that right on the table. I'm talking about horrendous, okay? So I do not like to recommend horrendous stocks. It is so low that it comes in under the category of speculative. But as long as you're willing to take the pain, they can't, you said it, they have a lot of money. But wow, I have to tell you, bad taste in my mouth. Bad. Let's go to Mark in New Jersey. Mark.
Booyah, Jim. Second time caller here, man. Hope you're doing okay. I wanted to know your opinion about the nuclear sector, and more specifically, if I should be buying more, holding, or selling NuScale Power SMR.
The only one to buy is GE Vernova because they actually know how to build one of these things. I want you to scale out on the way up. Is it 23 at 25, sell some at 27, sell some at 30, get rid of all of it. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's digging deep into the turnaround at bargain retailer Five Below and seeing if the company can keep things up or if the price is just too high. Next.
I love turnaround stories. If you catch a turnaround early, you can make big long-term money. And that's especially true in retail, where comebacks are very hard to find. But if you do find them, they tend to be bountiful. We're seeing one right now in Gap under Richard Dixon. We've seen one in Williams-Sonoma, of course, traded by Laura Alber. I like what's happening at Tapestry under Joanne Cravasarat. And who can quibble with the work that Patrice Louvet has done resuscitating Ralph Lauren? But to me, you know what? The most impressive turn right now is the remarkable resurrection of Five Below, the largely kids-themed store that just delivered its second consecutive quarter of over $1 billion in sales, with so much more growth ahead of it. As is often the case in retail, the person at the helm either makes or breaks the business, and CEO Winnie Park has made it, taking the stock to heights that would have seemed impossible when she was appointed a year ago today. At the time, Five Below had lost its way, falling behind the industry in both new ideas and profits. The company had become a serial disappointer and even a bit of a joke versus its competitors. Under Park, that's all changed. Something that's obvious from the amazing quarter they just reported, the one that sent the stock up another 5 points. It's up 60% so far this year. Of course, some would say that she inherited a better than expected company with improvement coming from the immediate predecessor, interim CEO Kenneth Bull. Look, he deserves some credit, but it's Park who set up Five Below for multi-year growth, even as the chain already has 1,900 stores across almost every state in the union. And look, the numbers were incredible. In the latest quarter announced last night, Park delivered an astounding 14% same-store sales growth, almost unheard of for a chain like Five Below. Some of the transformation comes from going back to basics. Park has worked hard to, as she said in the conference call, sharpen the focus on the customer, the kid. Second, she's using digital channels and social media to help drive people to the stores. Third, she's developed what Five Below calls curtain-up moments, holiday merchandise for 6 different occasions. She says it's management job to please the boss, which isn't her, it's the customer. She killed it in the 2 most recent curtains up, Halloween and back to school. They caused sales acceleration throughout the quarter, and now we're in the biggest shopping season of all. Some of the success came from scrapping the Five Beyond section of the store, which had hobbled stores with a kind of a no-fly zone of expensive merchandise. They've taken that space for big-time seasonal merchandise instead. Now, there's some secret sauce we don't know about. Five Below had some of the worst pilferage in the industry last year, just rampant shrinkage, technical term. It's now down a great deal because of mitigation efforts. But management didn't tell us how they did that. We don't know how they avoided taking a profit hit from tariffs either. Something that the tariffs took this stock down very hard. There'd be another buying opportunity. All in all, I think Five Below's story is all about curation. Park uses terms like generation of content, not clothes, content, not toys. She's basically putting on 6 shows a year that are driving an immense amount of traffic. The changes, though, are still in their infancy. That's why I think that Five Below, last year the butt of many jokes, is firmly in the turnaround mode. A successful turn can generate years of terrific gains for you, the shareholder, meaning the stock might indeed have a lot more room to run. I'd like to say, as always, bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.